Is now a good time to invest in bonds? The answer is really it depends. So your next question in response might be, okay, Francisco, what does it depend on? And the reality is, we're going to learn from this chart today. The answer is your time horizon. For example, if you have a short-term goal to invest, it might make more sense to have a larger percent of your portfolio in some short-term products like money markets, short-term CDs, T-bills, and you can ladder those out using some pretty standard techniques, or you can even look at some funds that incorporate all of those things. The reason is because you are planning to use this money short-term. You can't afford for the market to wreak havoc on this portion of your portfolio when you need to use it. You can't sell this stuff when it's down. But what if you're planning for a long-term goal? Do bonds make sense? We believe they do for two main reasons. First, it provides a really good opportunity to diversify your stock components from your portfolio. You just need some of that hedge against market volatility. Second, the return for bonds are pretty optimistic since they're now providing income more income in recent memory due to all the great interest rate environments today. In fact, if you look at PIMCO's charts, they have provided proof that the starting yields or higher payments from bonds actually have almost a 100% of a 94% correlation to future potential returns. So what does that mean? Well, some of you are thinking, shouldn't I wait until the Federal Reserve cuts rates before investing in bonds to take advantage of bond prices increasing as the rates fall, right? I mean, as bond rates fall, bond prices will increase, right? Wouldn't that be a good trade-off? And that's actually a really good question. But here we can see the research, the data shows that the average bond return of the last 4 times that the Fed stopped raising rates shows that the strongest returns are within 12 months of the last rate hike. Look at the chart below. So this is from our friends at Capital Group. And what we see here is that if you would have waited until the Fed started cutting rates, you would have actually missed most of that positive return. And the reason is that the average time between the final rate hike and the initial rate cut has been 10 months. And so you don't want to wait that amount of time. So what does this ultimately mean? Realistically, trying to time the interest rate cycle is a losing effort. We are not fans of trying to time the market. It just doesn't prove effective. With the Fed right now hinting that they are content on keeping rates higher for longer without any foreseen any coming rate hikes for the moment, but also no cuts coming for the moment, now's the time to consider moving that cash back into those long-term fixed income buckets and slowly invest into bonds in order to lock in today's higher rates that these bonds are offering. Relative to shorter products, it's just a better long-term return. So if you're looking for a partner on these financial issues and you want to help yourself build that life you love to live without worrying about all this stuff, consider letting us run a diagnostic on your portfolio. You can find our information below.